Welcome back, you legends. I'm Dr. Ken. Let's get right into this video. This is by far the most important video I have ever made. Please, if there's just one video you're going to watch from the beginning till the end in the entirety of 2023, please make it this one because it's going to change your life. I very rarely say this, but I'm saying it now. Please, this is the most important video by far. So let's get right into it. The S&P 500 is down 1.56% today, the NASDAQ 1.24%, and the Dow 1.81%. Let's take a look at the different sectors right over here. Lagging today were defensives, utilities, and energy, as well as financials. So the value-oriented stocks in the Dow Jones saw massive selling today after weeks and weeks and weeks of relative strength. We're seeing money flow out of these stocks. Interestingly, every single sector is in the red today, but tech and communication services fared slightly better than the rest. This is sort of what we were used to seeing back in the day before inflation, and this is pertinent. Why? Well, because let's take a look at this, guys. Today, the PPI, Producer Price Index, came out, and it came out negative 0.5% month over month. Retail sales in recession territory, negative 1.1%. The forecast was less than half of that. So we're seeing an acceleration not only of inflation coming down, which a lot of people expected, including me, but we're also seeing the economy falling off a cliff. Remember back in 2022 when things were focused on bad news, i.e. weak economy being a good thing, check mark, because that would mean slowing inflation. Well, now bad news is bad news again, because take a look at this, guys. Look at this absolutely enormous red candle today. We closed below the 9-day moving average for the first time really since this consolidation zone back in late December. And it's because bad news is bad news yet again. It's no longer about inflation, it's about recessionary fears. I was saying this for months and months and months throughout this bear market rally. I was saying that the focus will shift towards recession fears and no longer inflation, because I believe that inflation had topped and will begin rolling over. And I still continue to believe that inflation will continue to come down as long as the Fed does not pivot. Now, I do have some crucial data to talk about in the S&P 500 regarding the 2008 bear market and the 2000 to 2003 bear markets. The last two major recessions, the last two major bear markets are on repeat, guys. The exact same things are happening again. You will want to stick around to the end of the video because I'm going to show you some bombshell data. Now let's try to understand this price action a little bit better. Yesterday I posted this in the trading community. The SPY weekly chart has printed a perfect tag and rejection of the resistance line. My base thesis is still that we break above it, form a false break followed by a waterfall sell-off. This will likely happen after we pull back to 390, creating massive FOMO and a deadly bull trap. FOMO, fear of missing out. Throughout the last couple of weeks, we saw AMC, Bed Bath & Beyond, all of these garbage stocks rallying to the moon, as they say. And this happens all the time when we get into the greed territory on the fear and greed index. Now, keep in mind that we have PPI before the market opened tomorrow, so instead of a gap down, we can see a gap up above the resistance line. Bulls take profit and bears pile in and then print a big indecision candle, rally in the morning, followed by a sell-off afternoon with a big red candle flushing us down to 390 the next day. Now, very interesting, guys. We had that gap up exactly as we expected. We had the gap up above the 200-day moving average. And let me show you the 1-hour chart. Look at this. A perfect indecision candle followed by a big old red candle. Now, interestingly, the price action that I expected to unfold over 2 days happened exactly the same as what you would expect, but it happened in a compressed time frame in a single day. So we did end up getting that indecision candle and a massive flush down, but it happened over 1 day, not 2 days. Now, we do have some support at $390 at this gap fill level. I do expect some bulls to try and hold this level. Now, they will need to hold this level because if they don't, it will probably mean that the crash has started. Now, I do share my S&P 500 projections in the trading community in this chart, guys. There's a live link to this chart in the trading community for those interested. It's $50 a month and you get access to all of my analysis. Now, this is my current expectation. My current projection is that we rally to the 200-day. We did that, right? And then we go back to test this support line. We try to rally again, get rejected, fail, form a slightly lower low, and then we move back down. That is still my expectation. I still think that the bulls will try one more time, and then get a massive sell-off in early February, beginning that big crash all the way down to 3,200 by March, right around this level, guys. By the end of March, I expect the S&P to trade all the way down to 3,200 because of several reasons. Number one, we have this support level right here at 3,200. We also have this massive gap. Let me get in a little bit closer so you guys can see it. Look at this enormous gap at 3,200. And then we have this consolidation pattern, this sandwich with support at 3,200. And we have a massive volume gap at this zone. That's another reason that it acts as a magnet. There's really an air pocket of volume. In fact, let me show you this air pocket. Here it is, guys. Do you see it? This is the volume shelf profile. And we have this enormous air pocket right over here at 3,400, around 3,300, all the way down to 3,200 at this support zone. We have this really enormous gap in the volume. These zones, guys, act as magnets and acceleration zones. So as soon as we break below 3,600, you will see a quick flush down all the way to 3,400. And I expect the market will try and chop around and find support at 3,200 yet again, exactly like what happened back in September. Now let's jump back to the trading community because I want to point out the truly breathtaking discoveries that you will make in this video by just looking at the charts. Now, let me just read this very quickly. This feels quite fitting for the moment. It looks like the Santa rally did come only a month late. There will come a point in time when we will begin doubting whether this is still a bear market, and that's when we're going to go short again. Now, I'm quoting something that I posted. Look at this, November 16th, 2022. More than 2 months ago. I am still bearish long term going to next year, but that's irrelevant at this point. The market is behaving like it believes the stock market has bottomed and is beginning a brand new bull market. I completely disagree, but that's besides the point. We have to trade based on the majority of what market participants believe, not what we think. For this reason, this rally can get much crazier as we get into December and as it turns out into January as well. There will come a point in time when we'll begin doubting whether this is still a bear market. That's when we're going to go short again. Now, this was in November, guys, middle of November. What did the stock market look like? Let's see. Look at that. This is what the market was doing. It was rallying. And I was talking about how December could get really crazy. Interestingly, the Santa rally did come, but it came a little bit late into mid-January. And I do believe that we are now in the final innings of this bear market rally, and we are entering a new recessionary style, complete massive wipeout, massive sell-off, not like this choppy trading, this 45-degree angle sell-off that we've seen throughout 2022. No, something completely different, something that looks like we're falling off a cliff's edge. And I'm going to explain exactly why that's the case. And it's absolutely uncanny. So let's get right into it, guys. This is the most important part of the video. Please pay very close attention. I want to point out two very clear and obvious identifiable patterns in this bear market. Number one, we have a descending resistance line that held throughout the bear market once, twice, 3 times. We briefly broke above it. the fourth time, and we will likely break above it for the final time. A break and a final massive sell-off. So that's number one, the descending resistance line. Number two, let's take a look at the weekly chart. On the weekly chart, we have this very obvious, very clear double bottom, lower low on the second bottom, and a slightly higher low on the PPO. This is typically a powerful bottoming formation, a double bottom with a positive divergence on the PPO on momentum. Okay, now we have a resistance line that's descending and a double bottom. Now let me show you what happened in 2008. It's absolutely uncanny, guys. Look at this. Now, I did point this out in the trading community several days ago because it just looks absolutely insane to me. Look at this, guys. Very clearly defined descending channel, very clearly defined resistance line. Now, look at this double bottom, lower low on the second low, higher low on the PPO on the momentum. Let's take a look at the daily chart. And this is kind of where your mind will melt. Look at this, guys. One rejection, two rejections, three rejections, a fourth rejection, brief break, even closing above the 200-day moving average, failure of that break, one final attempt, head and shoulders top, and look what happened next. Massive sell-off, anemic rally, and then the mother of all sell-offs in late 2008. Now, from this resistance line all the way to the bottom of the bear market, let's take a look. Look at this, guys. More than 50% wiped. So if you went long here, you would have lost 50% of your net worth in a matter of a year, and you will not have recovered for years and years and years. Let's take a look, guys. 2008 May. Oh, did we recover several years later? This was 2008. This is 2011 May. 3 years later. No, we did not recover. Let's take a look. When did we recover? 4 years. It took 4 years. So if you went long here thinking that this is a new bull market, we're in a bull market, etc. Let's go long. Double bottom, everything's so clean. We had a break of this resistance line. Let's go long. You'll have lost 50% of your net worth and you will not have made it back for 4 years. Now let's take a look at the 2000 bear market. Let's take a look at the 2000 to 2003 bear market. Look at this, guys. Very clean resistance line. Held once, twice, 3 times, 4 times. Brief break on the 4th time. We traded above the 200-day. This dark blue line is the 200-day moving average. We traded above it. This is a new bull market. And not only that, let's take a look at the weekly. This is uncanny, guys. Let's take a look at the weekly. Now on the weekly, what do we have here? A double bottom, lower low on the second low, higher low on the PPO. After that, a rally. We broke the resistance line. Briefly, we took out the 200-day moving average. And then we ended up failing massively, enormously. We had this enormous sell-off. Let's take a look. After the break, all the way to the bottom, 33%. And how long does it take to recover your money if you went long here? This was March 2002. And you would not have even recovered in March of 2004. 2 years later, you would have broken even if at most broken even. You will not have made a profit for at least 2.5 years later. That's the danger of thinking that, yes, if we take out this resistance line, if we take out the 200-day, it's a new bull market, let's go long. I don't want to miss out on this rally. Crap. Absolute garbage. Absolute crap. Now let's take a look at the chart right now. What do we have, guys? Look at this. Again, rejection, rejection, rejection. 3 rejections. A 4th brief rejections. We are now on our way, very likely, in my opinion, to trade above the 200-day, take out this resistance line, and history repeats itself yet again, and we get a massive massive sell-off. That's why this is by far the most dangerous time to be thinking about going long, buying stocks for the long term, because if we get that same thing that we had in 2008, 2002, and we will likely get it, guys, because the economy is slowing down massively. This is the fastest rate hiking cycle even beyond 2000. This is the fastest in 50 years. In 50 years. The economy is weak, inflation is still high, and the Fed is still tightening. There's no way the market has bottomed. Absolute insanity. Here it is, guys. In both the 2008 and the 2000 to 2003 bear markets, there was a very clearly defined resistance line hovering right at the 200-day moving average. Here it is, resistance line hovering right above the 200-day moving average. This blue line is the 200-day moving average. This is Exhibit A. Let's take a look at 2008. This is 2000. This is Exhibit B, 2008 resistance line hovering right around the 200-day moving average. What do you know? Exact same thing. Let's take a look at Exhibit C, the third exhibit, the 2000 bear market. What do you know, guys? Another resistance line hovering. Oh, look at that. The same 200-day moving average. Okay, so what happened? The S&P ended up crashing down by 35% after this signal in 2002 and a shocking 50% in 2008. This exact same signal, the break of the resistance line, the trade above the 200-day, and the failure of that break will very likely trigger within the next 2 weeks. That's just my projection, guys. It could take longer, it could happen earlier. We don't know quite yet, but 2 weeks sounds about right. A close above the resistance line and a close above the 200-day moving average, marking a top in the market that we will not revisit for several years to come. And 2 weeks makes sense for a lot of reasons. Number one, we have a lot of earnings coming out in the next couple of weeks. And most importantly, guys, in February, early February, February 1st, we have the Fed interest rate decision, the Fed meeting. This will likely be a significant negative catalyst as the Fed slaps the market yet again back into reality. It took the S&P 3 years to recover in 2008 and 2 years in 2002. The Fed is still in the middle of the fastest rate hiking cycle in half a century into a weakening economy. Into a weakening economy. This has never happened, ever. The Fed has never hiked rates into a weakening economy. It never happened. This is by far the worst possible time to be thinking about, oh, this is a new bull market, let's go long. Whilst the global yield curve is inverted, a first in over 20 years, and people are calling for a bottom and a new bull market. Pure insanity. Absolute, total insanity. Now, interestingly, guys, as of today, I am again net short. I have 0 long positions, 100% cash in my investing account, a significant cash position in my trading account, and all short positions in my trading account. We did go long. We did trade this move to the upside. And let me show you what we did exactly. I've never done this in any prior video. I'm going to show you some of our trades. And so you guys can familiarize yourself with the trading community. This is the trading community. I post all of my trades in my trades right here. I post intraday, pre-market, and post-market live analysis, as well as live coverage of key events like the PPI release, the CPI, Fed interest rate decisions, etc. I also post my investment ideas, my weekly watch list, and weekly expected move for more than a dozen different products, including the S&P, the Russell 2000, the NASDAQ, as well as a lot of stocks like Nvidia, Microsoft, Apple, Google, etc. Okay, I also post a live link to every single one of my charts that you see in the videos, my projections chart, my CPC buy and sell signal, my ratio charts, all of my indicators that I spent my entire life building, refining, working on, improving. They're all in my charts. You'll get all of them. We have over 1,700 active members, and I will likely cap the number of members at 2,000 for a little while to see how well we can scale. Because guys, I interact with everybody. I answer everybody's questions as best as I can in the ask questions here section. So I really try my best, guys, to interact with everybody as often as I can. We do have 1,700 members, so it's a bit of a challenge, but I really love it and I will continue to do it. It's $50 a month if you go for the Ghost Legend membership, which gives you access to all of this stuff, but you'll only be able to comment in one section. There's also the Living Legend membership, which is the same price really. It's $50 a month, but you can only sign up for an annual membership. So if you guys are looking to access all of my analysis, my trades, all of the trades that I take personally in my trading account, I post all of them. They're not meant to be followed, guys. It's just my way of showing you how I apply my analysis, so you can really become autonomous in your trading and be consistently profitable on your own. That's my goal with this trading community. But I do share all of my trades because I really think transparency is key. A lot of people will do a lot of videos, analysis, etc., but you never know what they trade. So I show you exactly what I trade, when I trade, all of that good stuff. So guys, memberships are $50 a month if you go for the Ghost Legend membership, and $35 per month if you go for the Ghost Legend annual plan. And this discount is still in effect as of today. Ghost Legends can see all of my work, the entirety of the server, but they can only comment in one section. That's it. Living Legend members can interact with everybody and they have access to all of the rooms and they can comment in all of them. It's also $50 a month, but you can only sign up as an annual plan at $600 a year. Again, this membership is capped at 1,000 active members, but when this video goes out, I will open 10 slots. So if you're interested, you can sign up, but they go really quickly, these slots. So just try your best to sign up as soon as you see the video. A link will be in the description to join the trading community. Here is an example of our trades, our recent trades. I actually bought Tesla at 120. Here it is, guys. I'm going to show you exactly when I bought Tesla. It was right here at this candle, this pullback. I went long Tesla and I sold at the open today at $135. Exactly at the open. As soon as the market opened, I sold all of my stock. I also bought CrowdStrike at $96.9. I sold it at $105 exactly at the open today. I went long Fortinet I think a couple of days ago, and again I closed that position just as the market started to turn around. I was hoping that this name could rally a little bit longer, but it didn't. So we closed all three of our long positions. And again, guys, I'm applying the same analysis that I work on, that I share with you guys. Right, I said that we will see a gap up and then a sell-off. Bulls take profit. That's exactly what I did. It's what I expected would happen. It's how I reacted to it, exactly how you would expect, really. Market gapped up. I sold at the open because I expected a sell-off. That's what I did. And then I went short. I did not share that short position because that position is still open. You can see that position in the trading community if you're interested. Again, the link will be in the description below. Oh, look at this smiley face. Let's clean this chart really quickly and let me get into a bunch of really insane stuff that's going on. Let me really quickly clean the chart and come back. Okay, all cleaned up. So let's get right back into these charts. The weekly chart, the SPX, again, perfect weekly rejection. I still think we can close above this resistance line. And even if we do, as I outlined in the video, in 2002 it happened, in 2008 it happened, and the market crashed, okay? So it doesn't matter. Even if we clear this resistance line, this is not a new bull market by any stretch of the imagination, unless you're watching CNBC and they're lying to you. That's it. That's really it. Let's take a look at the Qs. We had this beautiful, beautiful ascending wedge pattern. The ascending wedge is a bearish pattern that usually breaks to the downside. The psychology behind it is that the market is rallying, moves up to the upside, and then begins to slow and contract towards the tip of the ascending wedge. As soon as you see a break of the support line, you go short. That's basically how you would trade this ascending wedge. That's basically what we did. Not in the triple Qs, but we did buy puts in some other stuff. Now, interestingly, the triple Qs are actually still outperforming the S&P and the Dow Jones, which is a very interesting development, right? We saw this really interesting sector rotation the last couple of weeks. Throughout the rally, we saw the Dow Jones Industrials really blowing everything else out of the water. Here it is, guys. This is the Dow Jones. Look at this absolutely enormous rally, Dow Industrials. Let's take a look from the bottom to the top. We had a 20% rally. We had a very shallow pullback, and we are now really losing that edge. If we take a look at the triple Qs, it looks kind of disgusting, right? We had this terrible small rally, 13%, 14.5%, a deep sell-off, and then we began to finally show some relative strength against the Dow Jones recently, as again, yields came down, as inflation came down. The inflation trade sort of went out of fashion about the last 5 trading sessions or so, and then we saw money move into growth stocks and out of value stocks. And this is what you would have seen typically before 2022, back in 2020 and 2021. You would have seen the NASDAQ consistently outperforming the Dow Jones. But as inflation was super high, we saw the Dow rally. Now, interestingly, again, another really beautiful trend line from the top. This is a trend line based on a closing basis, guys. Okay, so it's on a closing basis, not including the wicks. So from the top to the top on a closing basis on November 30th, this beautiful trend line, and we had a beautiful, perfect, picture-perfect rejection. Look at this. We rallied, we touched it, we came back down, then we sold off yesterday, and they had massive selling today. We completely reversed this entire move to the upside in 2 days. 1 day, 2 days, that's it. We reversed, let's see, 1, 2, 3, 4, 5, 6 days of upside, completely wiped out in 2 days. That's how crashes develop. That's how major tops develop. In my view, in my humble opinion, this is a top, a double top in the Dow Jones with significant, massive negative divergence, okay? Now again, interestingly, guys, if you go back to 2008 and 2002, you will see this exact same setup. I swear I'm not making this up. Look at this, guys. We had this strong rally, took out the 200-day, made a new high relative to the prior high. We stalled. Then we had a lower high as we hugged the 50-day moving average. Then it failed and it broke down. Here it is, guys, 2002. And does this look familiar? Bottom, major bottom, big rally, shallow pullback, another major rally at the prior highs, taking out the 200-day, trading above it for several weeks, even a month, okay? Then it broke down, and then we had this final retest of the 50-day, failed, and a massive sell-off. Does this not look familiar? Does this, just please tell me, does this not look familiar to you? I mean, if we did not have the historical data from 2002, maybe this would have been a tricky trade. Maybe this would have been a tricky situation. Oh, is this a new bull market? Is this not a bull market? Really, if you follow the fundamentals, this is by no means a new bull market. Absolute impossibility. Economy slowing down. Major earnings revisions down below expectations. We're seeing the exact same things happen again, guys. Break over the 200. We rally. We have a double top, then we topple over. You can't make this up. You absolutely can't make this up. And people were calling this a new bull market. Absolute insanity. Just total crazy talk. Now let's take a look at the Dow Jones transports and the industrials. This is the Dow theory model. This is a chart that's available in the trading community, and I do track it for divergences. Interestingly, Dow Industrials are now significantly underperforming the Dow Transports because the Dow Transports tend to be more growth-oriented stocks like Uber, etc. And we saw throughout the 2020 rally, if you guys remember, and the 2021 rally, the transports significantly outperformed the industrials. Then we had this massive top in the transports and a lower high, followed by a slightly higher high on the Dow Jones Industrials, formed a significant negative divergence, and then the bear market basically began. So what's happening now? Very likely this top will match up with this top and the Dow Jones will very likely now begin to sell off massively, try to recover, fail, and come back down, exactly like what happened in 2002. Something that looks like this. As the 50-day begins to turn back down, we get a rejection on the other side of the 50-day, and we see continuation of the selling into March and into potentially April, but very likely by March into late March. Now let's take a look at the dollar index. Again, look at this perfect tag of our support, this level right here, perfect tag. We had this massive indecision candle. These indecision candles, guys, these massive indecision candles usually signal reversals. When you see them at the bottom of a trend, they usually signal reversal to the upside. When you see them at the top of a trend, they usually signal reversal to the downside. Let me show you a few examples. This is an example right here, indecision candle followed by a sell-off, mark the top. Another one is right here, couple of indecision candles followed by one final push up and then a sell-off and confirming the top. On the bottom, you can see them right here, an indecision candle at the bottom, signaling a reversal. Another one right here, signaling a reversal. Another one right here, signaling a short-term reversal. So why do we look at the dollar? Well, basically, guys, because the dollar loves to crush the stock market. When the dollar moves up, stock market valuations come down, especially growth stocks. As well as gold. Really, growth stocks and gold move in tandem most of the time. Interestingly, however, something fascinating happened. Look at the 10-year yield. Usually, the 10-year yield moves with the dollar. When the dollar breaks out, when the dollar shows a bottom, the 10-year yield begins to move back up. Instead, we had this massive flush down. Now, this to me tells me that the market is actually now not afraid of inflation. No, the fear now is growth, is recession. And when there's an overbearing fear of recession in the market, money flows out of the stock market. Boom, stocks go down. Yields go down because money flows out of the stock market into bonds. When you buy bonds, you push the price up. When the price moves up, yields on those bonds go down. Okay, there's an inverse relationship between yields and bonds. Bond prices move up, yields move down, and vice versa. So fascinating development this time around. It's exactly why you saw the Dow significantly underperform the NASDAQ, right? Because growth stocks and gold like weak growth environments, not a recession per se, but weak growth. They like that because those environments mean lower interest rates, right? Lower interest rates, high bond prices. Those translate to higher valuations. So even if we see a complete crush of earnings, higher valuations can counteract that. And that's why you see the NASDAQ today significantly outperforming the Dow as the Dow saw that massive sell-off. Now, in a recession scenario, in a major bear market scenario, it doesn't matter really. Everything in the stock market goes down. Defensives, growth, value, it doesn't matter. Everything crashes. And so we are inching our way closer and closer to that moment where everything in the stock market moves down. The only thing that stays up is going to be very likely bonds as a safety play as money runs to safety. Let's take a look at another chart. This is breadth, stock market breadth, the percent of S&P 500 stocks trading above the 200-day moving average. And what do you know? Look at this massive, enormous negative divergence, a matching high here and a significantly lower high in the PPO. Tells me that we are likely forming a double top and we're going to go back down on breadth. And when breadth collapses, the stock market just falls off a cliff. Let's take a look at another interesting chart. Look at this, another breadth indicator. This is a faster breadth indicator. This is the 50-day breadth indicator. And what do you know, guys? Look at this. Failure. Oh, what happened? Oh, we failed. Now, interestingly, I did post this in the trading community weeks ago. I started to talk about this as we started to rally. I drew out this resistance line and I said, guys, be very careful. We had several failures of prior bear market rallies at these levels, several of them. And we got back into that exact same zone and we failed. Can we see some buying off this level? Perhaps. We don't know. It's impossible to know. We'll have to wait and see what happens tomorrow. Tomorrow really is going to determine whether this is going to be a significant sell-off coming in, right? If we just continue to sell off from here, or whether we stick to my projection of a sell-off, another top, double top, and then we continue to sell off. So I'm beginning to scale in short positions to account for the possibility that we could see another top. But there's no guarantee. If we take out this support line, guys, if we take it out, that's it. I think we just see massive selling from that point on. So I'm going to be watching the daily chart very closely over the next couple of weeks. Let's take a look at another chart. This is AMC, and what do you know, guys? Look at AMC. Every single time we had a massive rally in AMC, what happened? Oh, the market topped, the market topped, the market topped. Oh, the market very likely has topped. Very likely has topped. Can we see another attempt? Yes. And a failure? Yes, possible. Can we see a double top? Yes, possible. Have we topped? Very likely. Very likely we've topped. We could see a matching high, perhaps a slightly higher high, but we have likely topped at 400 bucks on the S&P. Let's take a look at another chart. This is the IWM Russell 2000 small caps divided by the S&P 500. A lot of people have been citing this chart to say that, oh, a new bull market has started because look at this. The small caps are outperforming the large cap S&P 500 stocks. Well, not really. Not really, guys, because number one, we did not take out this high. And number two, let me show you something fascinating. Yet again, if we take a look at the historical data, just the historical data, let's go back to, boom, the 2008 bear market. What do you see, guys? What do you see? What do you see here? Massive, enormous outperformance by the small caps as the market was tipping over and beginning to crash. So no, small caps outperforming large caps does not mean by any stretch of the imagination that a new bull market has started, because it happened systematically. It happened systematically in every major recessionary bear market that we had in the last 20 years. It happened in 2008, and it happened throughout the 2000 to 2003 bear market. We had this massive outperformance by small caps, but the market crashed. So it's by no means, guys, an indication that, oh, a new bull market has started or anything like that. That's just not true at all. Now let's take a look at the BPSPX bullish percent index for the S&P 500. This is the first time that I'm showing this chart, but I'm adding it to my videos because it's very interesting. Why? Look at this. As soon as we cross below 60, it confirms the market top. Again, below 60, we topped. Below 60, the market topped. Below 60, the market topped. Okay, can we see another attempt? Yes, perhaps, maybe, potentially. But very likely, guys, 400 is the market top. That's my base case scenario, is a market top and a double top coming in with a slightly lower high or a matching high. But very likely, the market has stopped. Very likely, the market has stopped. New York Stock Exchange, what happened here? Well, look at that. Boom, rejection at the exact same zone that we rejected in prior bear market rallies. The exact same spot. Again, I pointed this out in the trading community. So all the legends know about this because I talked about it. Rejection, 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 rejection. Can we turn back around? Perhaps. But even if we do, even if that happens, as long as the S&P is moving down, the New York Stock Exchange will follow suit. CPC buy and sell signal. Oh, look at this. What happened? We have a sell signal, an official sell signal as of right now. Here it is, guys. We went from 95, below 95, we crossed above it. That's my first criteria. My second criteria is a cross up on the PPO. We got both. This basically confirms a sell signal at this red candle. Can we see an attempted rally after that? Yes, perhaps. Can we see an attempted rally? Yes, perhaps. But we could also see just continuation of selling. Let's take a look at the PC. The PC buy and sell signal. I use this chart, guys, to corroborate the CPC buy and sell signal. It's based on a similar set of put to call ratio data. And now I'm looking at a bullish crossover on the PPO to confirm a sell signal. If we get that tomorrow, that will confirm the CPC sell signal. Let's take a look at fear and greed. Market momentum crossed above the 125 and we're now coming back down. Stock price strength likely forming a double top. Breadth forming a lower high. Put to call ratio beginning to move back up after putting in that head and shoulders top. I talked about that last week. And we are now moving back up at a very logical level. Market volatility. Oh, did I forget to talk about the VIX? The VIX. What does the VIX show? Well, the VIX shows a double bottom, lower low on the daily chart, and a significantly higher low on the PPO, a bullish divergence indicating that volatility will come back very strong, very likely as soon as next week. We'll probably see massive volatility flow into the market, into those earnings, into that Fed meeting on February 1st. And as we all know, guys, volatility, what happened when volatility moves up? Let's take a look at the S&P 500. Each bottom in volatility has marked a stock market top. There's a bottom there, mark the top, another bottom here, probably, very likely marking a top. Another one, boom, right here, mark the top. Another bottom here, mark the top. Let's take a look. Another bottom here, mark the top, another bottom. Marked the major bull market top back in early January of last year. So has the market topped? Very likely. Could we see a double top? Could we see another push up? Potentially, but very likely the uptrend has ended and we will likely either enter a period of choppiness or we just continue to sell off from here. What will determine whether we see chop or a massive sell-off is going to be this support line. If it holds, we'll see some chop. If it does not hold, we'll see massive selling. Market volatility, double bottom. Really bad time to be going long on the S&P or any stock really, unless you're unless you're just trading. Really bad time to go long, to buy and hold, to invest when volatility is low and rising. Really bad time, guys. Horrible timing. This is the time to be very careful, to go into cash, to hedge, to do all of those things. I'm personally 100% in cash in my investment account and all shorts in my trading account. Safe haven demand beginning to grow. Bonds are now beginning to outperform stocks. Junk bond demand, the yield spread is growing again. Money is flowing out of junk bonds into investment grade bonds. If we start to see unemployment tick up and we start to see PMI continue to move down, again, more signals a recession is looming. I'm anticipating, guys, that by the summer we'll begin to see the recession really slapping the economy in the face with earnings collapsing. If you're looking to support my work, a link will be in the description to check out the different memberships. It's the best way to follow all of the stuff that I do. It's way more efficient than producing videos, honestly. It's minute by minute, really very fast-paced, real-time, inside and outside of market hours. A lot of interesting discussions. Really enormous value from the community itself, aside from me. A lot of amazing community legends that I and every other member in the trading community can and has and continues to learn from. The videos are completely free, guys. They will continue to be free and they will continue to be free. Really, the only way you can support me is by joining the trading community and appreciating the video, liking it. Thank you so much for watching, guys. Thank you so much for sticking to the end of the video. I love you all, and just be very careful out there. Do not listen to the FUD. Thank you so much, guys, and I'll catch you in the next one. Bye-bye.
Oh, wow.